Now, up until this point in the course, we've focused on the quantitative side of liquidity risk, the hard metrics, the buffers, and the ratios that banks use to measure and manage their liquidity position. But numbers alone don't tell the full story. Supervisors also want to understand how a bank thinks about liquidity, how it governs it, how well it anticipates risks, and how prepared it is to respond when the unexpected happens. That's where the internal liquidity adequacy assessment process comes into play. In this session, we'll explore what the ILAAP is, how it works, what regulators in the UK and EU expect from it, and how banks can use it not just to comply with regulation, but to build a robust, credible, and forward-looking liquidity management framework. By the end of this session, you'll understand how ILAAP connects the dots between data, governance, risk appetite, and supervisory dialogue. Now, the ILAAP is part of the wider Pillar 2 framework under the Basel Accord. Now, while Pillar 1 sets out minimum quantitative requirements like the LCR and NSFR, Pillar 2 focuses on the internal processes banks use to assess and manage risks that aren't fully captured in the standard rules. So ILAAP sits alongside its better-known sibling, ICAAP, the Internal Capital Adequacy Assessment process. Now, where ICAAP is about capital adequacy, ILAAP is about liquidity adequacy. So at its core, the ILAAP is a document and a process that explains how a bank ensures it has enough liquidity in all relevant currencies and entities to meet its obligations as they fall due, even under stress. Now, it's submitted annually to the regulator and reviewed as part of the SREP, the Supervisory Review and Evaluation process. But the ILAAP is not just a report. It's a reflection of the bank's entire approach to liquidity risk. It includes governance, strategy, risk appetite, stress testing, contingency planning, and so much more. It must be tailored, credible, and aligned with the bank's actual practices, not a generic or box-ticking exercise. Now, in the UK, the ILAAP is reviewed by the PRA, which has published detailed supervisory statements outlining its expectations. In the EU, the European Central Bank and national competent authorities follow similar guidelines issued by the EBA, the European Banking Authority. Now, while there are some regional differences, the core principles are broadly aligned. So let's begin by looking at what a strong ILAAP needs to cover. First and foremost, it must include a clear statement of the bank's liquidity risk appetite. Now, this means articulating how much liquidity risk the firm is willing to take, under what conditions, and how that appetite is translated into limits, metrics, and decision making. The risk appetite should be approved by the board, reviewed regularly, and expressed in both quantitative and qualitative terms. It should cover things like minimum buffer sizes, acceptable reliance on different funding sources, and target levels for metrics such as LCR and NSFR. The next key component is governance. The ILAAP must explain how liquidity risk is managed across the three lines of defence. Who is responsible for what, how decisions are made, and how issues are escalated. It should describe the role of the board, executive committees like ALCO, and specialist teams such as Treasury, Risk, and Finance. It should also show how liquidity is integrated into business planning, new product approval, and strategic decisions. Regulators want to see that liquidity risk is not siloed, but embedded throughout the organisation. Another critical section is the liquidity risk identification process. Now, this involves describing how the bank identifies the sources of liquidity risk it faces, whether that's funding concentration, market illiquidity, contingent liabilities, intraday risk, or cross-currency exposures. The bank must explain the methodologies it uses to assess these risks, the systems and data sources involved, and how this analysis feeds into risk management. The goal is to show that the firm understands its own liquidity profile, not just through regulatory metrics, but in real operational terms. The ILAAP must also include detailed liquidity stress testing. Now, this is one of the most scrutinised parts of the document. Banks must describe the scenarios they use, the assumptions they make, the results they observe, and the actions they would take in response. Stress tests should include both idiosyncratic and market-wide events, as well as combined scenarios. They should cover multiple time horizons, currencies, and entities. Assumptions must be clearly documented, justified, and aligned with experience from past crises. Importantly, regulators want to see that stress test results feed into decision-making. For example, if a scenario reveals that the bank would face a shortfall in day 10 of a market-wide stress, the ILAAP should explain how the firm would address that. Would it increase its buffer, adjust its funding strategy, revisit its product pricing? The goal is not just to run the test, but to act on it. Another major component is the Liquidity Contingency Funding Plan, or CFP for short. Now, the CFP outlines how the bank would respond to a liquidity stress event in practice. It includes the governance process for invoking the plan, the triggers that would prompt action, the tools available to respond, and the communication strategies for internal and external stakeholders. It must be detailed, realistic, and tested. Now, regulators increasingly expect firms to conduct dry runs or simulations of their CFP to demonstrate operational readiness. Now, the ILAAP also needs to explain how the bank manages liquidity under normal conditions. Now, this includes describing how liquidity metrics are monitored day to day, how limits are set and reviewed, and how Treasury and risk teams interact. The document should show how the firm complies with the LCR and NSFR, how it manages intraday liquidity, and how it allocates liquidity costs internally through funds transfer pricing. The PRA places strong emphasis on the alignment between ILAAP content and actual practice, meaning the way liquidity is managed must match what the ILAAP describes. For international banks, the ILAAP must address group versus entity level liquidity. The PRA expects firms to demonstrate that material subsidiaries can stand alone in stress, without assuming group support. This means having entity-specific liquidity buffers, governance, and contingency plans. The ILAAP should also explain how intragroup funding works, what legal agreements are in place, and how these would hold up under stress. Regulators want to avoid a situation where liquidity appears strong at group level, but is fragmented or trapped in practice. Currency risk is another area of focus. The ILAAP should show how the bank manages liquidity across currencies, particularly for significant foreign currency exposures. So this includes describing FX swap strategies, currency-specific buffers, and the impact of currency movements on funding and liquidity risk. The PRA has issued specific guidance on foreign currency liquidity, requiring firms to monitor and manage currency mismatches with the same rigor as domestic liquidity. Now, an often overlooked part of the ILAAP is the link between liquidity and strategy. Regulators expect firms to explain how liquidity considerations influence business planning, product design, and growth strategies. For example, if a bank plans to expand its long-term mortgage lending, the ILAAP should explain how that growth will be funded in a stable way. If a new product requires committed lines or collateral, the liquidity implications must be assessed. Now, the document should demonstrate that liquidity risk is factored into decisions, not just measured after the fact. Now, from a supervisory perspective, the ILAAP is one of the key inputs into the supervisory review and evaluation process. Regulators review the ILAAP alongside ICAP, recovery plans, and other submissions. They assess the quality of governance, the credibility of assumptions, and the alignment between stated policies and actual practices. They also compare firms across the industry, identifying outliers or emerging risks. If a regulator identifies weaknesses in a firm's ILAAP, such as overly optimistic stress scenarios, insufficient contingency plans, or gaps in governance, they may impose Pillar 2 liquidity requirements. Now, these are additional buffer expectations that go beyond the minimum LCR and NSFR. The firm may also be asked to enhance its reporting, improve systems, or conduct remedial action. In severe cases, liquidity add-ons may become binding constraints, limiting the firm's ability to grow or distribute capital. Now, one of the most important features of a strong ILAAP is consistency. The assumptions used in stress testing must match those used in planning. The governance described in the document must match how decisions are actually made. The risk appetite must be reflected in metrics and limits. If a firm's ILAAP describes a conservative approach, but its balance sheet tells a different story, regulators will notice. That's why alignment is so important, not just to pass supervisory review, but to manage liquidity risk effectively. In recent years, supervisors have also begun using thematic reviews to assess ILAAPs across the industry. For example, the PRA may focus on how banks manage intraday liquidity or test the usability of HQLA. Now, the results of these reviews are shared with the industry, providing benchmarks and expectations. Now, this raises the bar for all firms and encourages continuous improvement. The message is clear. ILAAP is not static. It must evolve with the bank, the market, and regulatory expectations. Now, let's briefly talk about presentation and ownership. A good ILAAP is not just a risk team document. It should be co-owned by Treasury, Finance, Risk, and the business. It should reflect input from across the bank. It should be approved by the board, discussed at ALCO, and known to key decision makers. The best ILAAPs are readable, coherent, and structured in a way that makes them useful, not just to regulators, but to the firm itself. Many banks are moving away from long, boilerplate documents towards more focused, strategic reports. They use dashboards, scenario matrices, and decision trees to show how they manage risk. They integrate the ILAAP with internal management information, stress testing outputs, and business plans. They use the ILAAP as a living document, updated as conditions change, rather than a once-a-year compliance burden. To summarise, the ILAAP is the qualitative heart of liquidity risk management. It connects metrics with governance, data with judgment, and regulation with strategy. It tells the story of how a bank understands and manages its liquidity, and how it plans to respond when that understanding is tested. A strong ILAAP builds trust with supervisors, confidence with stakeholders, and resilience within the firm. It's not just about meeting rules, it's about being prepared. In our next session, we'll explore one of the most critical tools for embedding liquidity discipline across the bank: funds transfer pricing, or FTP for short. We'll look at how FTP works, how it helps allocate liquidity costs, and how it shapes decision-making in every part of the bank, from lending desks to trading books. In session 8, we'll see how liquidity becomes part of the economic DNA of a bank, not just a risk to be monitored, but a cost to be managed and optimized. I'll see you in the next session.